There's a piece of advice almost every American kid grew up hearing. Save your money. Don't spend what you don't have. Be patient. The careful man wins in the end. For most of American history, that advice was true. Then, for about 15 years, from the late 1960s through the early 1980s, those rules stopped reliably working, and for most of those years, doing the patient, careful thing with your money was actively, mathematically, the wrong move. There was a stretch of time in this country when the people who saved lost ground. The people with fixed debt and real assets often came out ahead. The careful ones watched everything they'd built quietly lose value. The reckless ones, or at least the people Volcker thought were reckless, sometimes got rewarded. This is the story of the decade that punished the saver and of a quiet American man named Walter who did everything his parents told him to do and lost anyway. Meet Walter. Walter isn't one specific man. He's stitched together from thousands of working Americans living through the 1970s. 48 years old, foreman at a tire plant outside Akron, Ohio, married to Carol, 2 kids, a small house with a mortgage almost paid off. Walter believes in rules. He grew up in a household where you saved $1 of every 10 you earned, where debt was something you only took on for a house and only paid off as fast as humanly possible. Where the worst thing you could be called wasn't lazy, it was reckless. Every 2 weeks, when his paycheck came in, Walter walked into his bank, deposited part of it into a passbook savings account, and watched the little stamp numbers grow. The account paid 5.25% interest, the legal maximum at the time. Slow, steady, safe. By 1971, Walter had built up almost $20,000, a small fortune in his world. The down payment for his daughter's college, his cushion against any rainy day, his quiet private proof that the system rewarded patient people. Walter's brother-in-law Eddie did not believe in rules. Eddie, that same year, stretched himself to the limit to buy a bigger house. $30,000, 30-year fixed-rate mortgage, monthly payments that made Carol wince every time she heard the number. "He's drowning," she'd whisper to Walter on the drive home. "He's going to lose everything." Walter agreed. He felt sorry for Eddie. He also felt, quietly, privately, a little superior. Walter had savings. Eddie had debt. For about 2 years, that math seemed right. Then, the world changed. To understand what happened to Walter, you have to know what was happening above his head, at the level of governments and global markets, that he had absolutely no say in. It started, of all places, with a decision you may have heard of before. In August 1971, President Richard Nixon went on television and announced that the United States would no longer let foreign governments trade dollars for gold. The link between the dollar and gold, the one that had anchored the world's money since World War II, was cut. You may have heard this, called the end of the gold standard. What Nixon called a temporary measure became permanent. From that moment on, the dollar's value was anchored to one thing: belief. For a year or two, nothing visible happened. Nixon even imposed wage and price controls, trying to force stability long enough for the country to believe things were still under control. But beneath the surface, the dollar was drifting. Then in October 1973, war broke out in the Middle East. The Arab members of OPEC, angry at American support for Israel, cut off oil exports to the United States. Within months, the price of oil quadrupled. You have probably seen the photographs. Cars lined up around city blocks, tempers fraying, stations running dry by noon. But the gas lines were just the visible surface of something much bigger happening underneath. When the cost of oil quadruples, the cost of everything that uses oil, which is everything, starts climbing. Trucking costs more. Plastics cost more. Heating a house costs more. Food, which depends on diesel to plant, harvest, and ship, costs more. Prices began to rise, and once prices start rising fast enough, they create their own momentum. Workers demand higher wages to keep up. Businesses raise prices again to cover the higher wages. Workers demand more, around and around. This is what economists call a wage-price spiral. Once it starts, it is one of the hardest things in economics to stop. By 1974, American inflation hit 11%. 11%. In 1 year, the dollar lost more than a tenth of its purchasing power. Now, back to Walter. Walter's savings account, by federal law, something called Regulation Q, was capped at about 5.25% interest. The bank physically could not pay him more. Meanwhile, inflation was 11%. Look carefully at what that means. Walter was earning 5% on his money. The world around him was getting 6 percentage points more expensive than he was earning. Every single year his money sat in that account, it bought less than the year before. Not because he was spending it, because he wasn't. His $20,000 in real terms was bleeding out. quietly, steadily. While the stamp marks in his passbook kept ticking up, his actual buying power dropped year after year. Walter didn't fully understand what was happening. He just knew that groceries cost more, gas cost more, his wages went up, but never quite enough. And his savings, the thing he'd been so proud of, didn't feel like a fortune anymore. It would get worse before it got better. In 1979, a second oil shock, this one tied to the Iranian Revolution, sent prices climbing again. By 1980, American inflation hit 13.5%. For most of Walter's prime working years, the rate at which the dollar lost value was higher than the rate at which his bank paid him to hold dollars. Doing the patient, careful, responsible thing was, year after year, a slow, guaranteed loss. And here is the twist, the thing that, once you see it, you cannot unsee. Remember Eddie, Walter's brother-in-law, the one with the big mortgage and the wife wincing at the monthly payments. Eddie borrowed $30,000 in 1971 at a fixed rate. Whatever happened to the dollar, Eddie's monthly payment did not change. The numbers on his loan were locked the day he signed. But Eddie's wages, like Walter's, like most Americans, went up with inflation, slowly, painfully, never quite enough to feel rich, but up. So look at what happened, dollar for dollar. In 1971, Eddie's mortgage payment was a real strain on his paycheck. By 1981, the same monthly payment was a fraction of his now higher wages. Inflation didn't eat Eddie's debt. It ate the weight of his debt. The bank had loaned him expensive 1971 dollars. Eddie was paying them back in much cheaper 1981 dollars. Meanwhile, his house, the foolish, overstretched purchase Carol had whispered about, had nearly tripled in nominal value. Not because Eddie was a genius, because in an inflationary decade, real things, houses, gold, land, oil, hold their value, while paper money quietly evaporates. Now look at Walter. Walter's $20,000 in 1971 buying power was worth a nice new car and a year of comfortable living for his family. Even after 10 years of interest at the legal maximum, and after the taxes he paid on that interest every year, by 1981, his account held what about $13,1971 used to buy. More than a third of his real wealth had quietly evaporated, not stolen, not lost in a crash, just vanished, the way a puddle evaporates on hot pavement. Walter had done everything right. He had saved. He had been patient. He had refused debt. He had trusted the rules his parents taught him, and the system had punished him for it. Eddie had done everything Walter thought was foolish. He had stretched. He had borrowed. He had spent money he didn't yet have on something solid, and the system had rewarded him for it. To be fair, and this video is going to keep being fair, there are different ways to read this. Supporters of the 1970s monetary system argue this wasn't a moral failure. It was bad luck, oil shocks, a war, OPEC, the end of Bretton Woods, all hitting at once. The rules weren't wrong. The world threw a brutal combination at them. And many economies around the world were hit hard too. Critics argue something deeper. They argue that once a country cuts the link between its money and anything real, the temptation to inflate is always there. And inflation often transfers wealth from people who hold too much currency to people who hold real assets and fixed-rate debt. Not always by accident, often by structure. Both readings have a point. But for Walter, standing in his kitchen in 1981, watching the news and trying to figure out where his savings went, the argument was abstract. The loss was not. That is the lesson that burned itself into a generation. Not, inflation is bad. Something quieter and much harder to shake. The rules they teach you when you are young are written for a world that may not exist when you are old. Walter lived a long time after 1980. The inflation did eventually break, under a Federal Reserve chairman named Paul Volcker, who raised interest rates so high they nearly choked the economy to death. By the mid-80s, savings accounts paid real money again. The rulebook seemed to work again. But something in Walter had shifted, and it never shifted back. He kept saving. He had to. But for the rest of his life, he never quite believed in a savings account the way he had at 28. When his daughter got married, he didn't push her to put money in CDs. He pushed her to buy a house. Don't get fixated on the price, he told her. Just own something real if you can. When his son asked him about investing, Walter said something the boy didn't fully understand until decades later. A dollar is a promise, and promises change. That sentence is the whole story. Walter wasn't a gold bug. He wasn't a conspiracy theorist. He was just a man who had watched a system he believed in quietly rewrite the rules in the middle of the game. And memory like that doesn't stay with one man. It gets passed down to a daughter who feels a strange pressure to buy a home she can barely afford, to a son who buys a little gold every Christmas without quite knowing why, to a grandkid who hears "just own something real" and assumes it's a personality trait of the family rather than what it actually is, a wound. You, watching this, were probably born long after Walter retired. You've never lived through a decade where inflation kept coming back, year after year, until it changed how families thought about money. To you, inflation is mostly a thing that happens to other countries. But you are still living in Walter's shadow. Every time an older relative pushes you to buy a house, even when the math doesn't quite work, that's Walter's shadow. Every time someone says, "just own something real, don't trust paper," that's Walter's shadow. Every time a parent looks at your savings account interest rate and laughs in that bitter, knowing way, that's the shadow of a country where, for a long stretch, doing the right thing was the wrong move. And every once in a while, the shadow stops being a shadow. In 2022, for the first time in 40 years, American inflation crossed 9%. Gas lines didn't return. The world didn't fall apart. But for about 18 months, every American with money in an ordinary savings account watched it quietly lose value, the way Walters once did. Older relatives nodded grimly at the news. Younger people asked, for the first time in their lives, what was actually happening. And then it eased, and the country moved on. So the real question isn't what happened in the 1970s. It's whether the lesson still applies. And I'm not going to answer that for you. I'll give you two ways to see it. One, the 1970s were an anomaly, a perfect storm of oil shocks, war, and bad policy that we have since learned to manage. Modern central banks watch inflation like hawks. The Fed has tools Walter could never have imagined. Trusting a savings account isn't naive. It's how a working economy is supposed to function. Two, the form changes, but the pattern doesn't. Inflation often rewards people who hold real assets and fixed-rate debt, while punishing people who hold too much cash. Sometimes a country has the discipline to stop it, the way Volcker eventually did. Sometimes it doesn't. And the next time a war, a crisis, a panic, a wave of debt, anything, pushes the system again, the people who learned nothing from Walter will be the first ones hurt. Which view is right is up to you. But you should know you're not choosing in a vacuum. You're choosing in the long shadow of the 1970s, of Walter, of the passbook account that quietly bled out, and of a generation that learned the hard way that the rules are not always written in your favor. For a long stretch of American history, doing the right thing with your money was the wrong move. Most people today have forgotten that. So before you decide your relative's obsession with owning something real is just paranoia, ask yourself one thing. Did they not understand money? Or did they live through a decade that taught them something about it that you haven't had to learn yet?